Are traditional expert calls in the investment world becoming obsolete? According to Stream, they are, and you can access primary research easily and efficiently through their platform. With Stream, you'll have the right insights at your fingertips to make the best investment decisions. They offer a vast library of over 26,000 expert transcripts powered by AI search technology. Plus, they provide competitive rates on expert call services, and you can even have an experienced buy-side analyst conduct the calls for you. But that's not all. Stream also provides the ability to engage with experts one-on-one and get your calls transcribed free of charge, all for 40% less than you would pay for 20 calls in a traditional expert network model. So if you're looking to optimize your research process and increase ROI on investment research spend, Stream has the solution for you. Head over to their website at streamrg.com to learn more. Thanks for listening, and we'll catch you next time. All right, hello, and welcome to the Another Value podcast. If you like this podcast, it would mean a lot if you could rate, subscribe, review it wherever you're watching and listening to it. You know, obviously, value investors love 5-star ratings. With me today, I'm happy to have my friend Harris Perlman. Harris is a private investor. Harris, how's it going? Ooh, the ill-timed drink of water there. But Harris, really great to have you on the podcast. Let me start this podcast the way I start every podcast. Disclosure to remind everyone, nothing on this podcast is investing advice. You know, that's always true, but maybe particularly true today. The company we're going to talk about actually has a decent market cap here, but you know, insiders own a pretty hunky stake. It got kicked out of a few indexes. It is a little bit more on the illiquid side. So everyone should just remember all of those carry increased risk. Please do your own work, do your own diligence, all that type of stuff. That out the way, Harris, the company we wanted to talk about today is Seneca Foods. The ticker there is SENEA. You've kind of lit the microcap Twitterverse sphere on fire with, you've done incredible research on this thing. There was a little bit of an venti angle. It trades at a huge discount. But I am rambling. I have a history with this stock as well. I will just turn it over to you and ask you, what is Seneca and why is it so interesting?
Yeah, thank you. And you're right. This has been a very controversial idea, which is a little surprising to me because I think the metrics are not that hard to understand. But this company is the largest vegetable canner in the country, in the United States. So when you go to the supermarket, and not everybody buys canned vegetables, but they're very cheap. So especially if you're trying to save some money, you go to the supermarket and you buy a can of corn or green beans or peas. There's a very high likelihood that that can was packed by this company, Seneca Foods. So it's a company that has a lot of hard real estate. They have factories, they have warehouses, and roughly once a year, depending on the crop, they're going to bring in a lot of labor from outside of state, mostly from like the Texas area, and they're going to have a massive multi-month pack, which is after the food is harvested, it goes straight from the farm to their factory. And within, 24, 48 hours, it's in a can. And then they're selling it off to stores the rest of the year. And that's the business.
No, that's perfect. And I think there's a lot of things we can start with, but let's start with the reason I initially got interested. And again, I had a position, I sold it. And as you said, it's not too late, even though the stock's done well, it's not too late to get back in. But let's start with the event angle that I think attracted a lot of people, because I do think it sets us up nicely to talk about everything else. So I'll turn it over to you. The event happened from memory, it was June, but why don't we talk about the event that I think got a lot of people interested, probably got you doing the work that you did.
So this company is on the smaller end of, small caps, sort of on the larger end for micro caps. The market cap's around $400 million. The event angle is that this company had been included in one of the S&P indices, not the S&P 500. For people who know, there's tiers. There's the S&P 500 for the mid caps, then there's the S&P 400 for mid caps. The S&P small caps is the S&P small cap 600. I don't know why they choose different numbers for large caps, mid caps, and small caps. But this company had been in the S&P 600. So some number of index funds owned this stock because it was in the index, and it got kicked out of the index. And it got kicked out of the index because it was too small. So naturally, with the wisdom of indices being what it is, when something is too small, in this case, because it was very cheap, they kick it out of the index and then everyone sells it because they're required to. So the stock went down from, $60 at the start of the year and got down to almost $30 in around July 4th. And I was buying it at that point, even though I didn't know the company that well, because I thought at that point the numbers were just egregiously cheap, even if you didn't think the company was a decent company. And there was this clear, forced selling, right? So when something's got forced selling, the thing that, the reason I'm really, really excited about it now is because I've done a lot more research since that initial event. And I realized now through this research that the company is actually much better than I initially thought it was. And I think now there's actually an incredible amount of upside, more than I thought there was when I was first buying the stock. So that's why I wanted to, that's why I keep talking about it. That's why I wanted to come on and talk today. And, I don't know how you want to steer this, but I'm happy to explain why I think the company is much better than what I initially believed.
So the way I want to steer it is the first, I think there are three angles to the investment, right? And the first angle is the one that me and a lot of people played in kind of small size, hey, the stock went from 50 to 35 on an index kick. We bought it in the mid 30s. We sold it in the mid to high 40s as the index kicks normalized. So that's number one. That's up. And then I think there are two further levels to it, right? The second level is the one I want to go into next, which is there's a lot of asset value here, right? And the people who did number one were definitely thinking about that. And I think that's still in play, a lot of asset value. So I want to talk about that. And then number three, I want to talk about, hey, more than asset value, maybe it's not, this isn't Apple in 2012 or 2014 or something, but there is a business here where I think a lot of people think, I would never pay more than 40% of book for a business that packs canned vegetables. And I think what you're saying is, again, this isn't the growthiest business. This isn't the modiest business, but is a good business that will earn decent returns on capital. So let's go to number two. Asset value, right? You and I are talking, the stock is in the low 50s today. There's a lot more asset value here. There's an accounting quirk that people who have done investing for a while are probably familiar with, but if you've been dealing with the Apples and Teslas of the world, you probably haven't thought about LIFO accounting in a long time. So why don't we talk about asset value and kind of the accounting quirk here?
Okay. So I've been using the word LIFO more in the past month or two than I have in my entire life previously. Because I've been trying to explain LIFO. And the fact is, the vast majority of investors, they just don't know what LIFO is. LIFO is last in, first out, and it is different from FIFO, which is first in, first out. And it's a way of treating inventory in accounting. So LIFO is a rarely used inventory accounting method. And I think there's a tendency, the government probably has tended to want companies to use FIFO instead of LIFO because LIFO lowers a company's tax bill and the government likes it when companies pay more taxes. But the company is allowed to use LIFO and they've chosen to use LIFO to save on taxes. Yeah,
I don't know if it's I think it's decently commonly used. I immediately pulled up US Steel, and US Steel, if I remember correctly, uses LIFO. I think the two things are, you are correct. The government, so I do remember there is a law. Look, if you want to use LIFO for tax accounting purposes, and LIFO last in an inflationary period, last in means your last things are the most expensive, so it will reduce your tax bill. And the government does have things says, hey, if you want to use LIFO, great, but you can't report to investors FIFO, so you've got higher earnings, and then use LIFO for your tax bill. I believe that's a thing. And then the second thing is, we went through 20 years where inflation was low, moderate, not very volatile, right? So with 20 years of that, I think you are correct. Investors kind of thought, LIFO versus FIFO, if inventory is turning over twice a year and inflation's 2%, what's the difference? So I think a lot of people just forgot about it. And here you had, vegetable and canned vegetable prices can already be volatile, but when you've got the huge inflation we saw in 2021, the supply chain issues, it actually made a big difference for this company in particular, LIFO. So I've rambled a little bit. I'll toss it back to you.
So you're right. So LIFO, last in, first out, means that you're counting you're counting inventory based on the most recent purchases of inputs. So in this case,
have you seen the meme of LIFO versus FIFO accounting?
I think I have, unfortunately, because somebody sent it to me after I started writing about it.
It's a little graphic, but it's the best way I've seen to describe it. LIFO is, look, last in, first out. If you take food in and then you end up, vomiting it out, that's last in, first out. FIFO, right. First in, first out. If you eat food and then poop it out, that's FIFO, right? Whatever you eat is the next thing that comes out. So,
and just like LIFO, and just as in the real world, most people are much more familiar with the FIFO way of doing things. Hopefully. So look, like in an inflationary environment, this company is going to pay more for inputs like steel, which are used to make the cans, and it's going to pay more for the raw vegetables from farmers, and it's going to count its inventory as if the most recently purchased steel and vegetables are the ones that it's selling. And over time, this means that it's always counting just the recent stuff. And as long as it doesn't sell all of its inventory in a short period, it's going to continue to have this kind of base inventory that's going to be calculated as from GAAP purposes based on prices from 15 years ago, which is actually when they first started using LIFO. The company did this switch. They switched from FIFO to LIFO, I believe it was 2008, to save on taxes. And it's been an incredible success. They've saved like $50 or $100 million so far on their tax bill. But you're right. So they have to report to investors, and in the GAAP numbers and the SEC filings, they're reporting to investors on FIFO. And it makes the company look worse because they have less taxable income, right? They have a lower book value. So yeah, when you get back to the asset value of the company, I think the book value today is like a little under $600 million, I believe. There's no intangible, so it's all tangible book value. But there's a $300 million pre-tax LIFO reserve. And if they don't switch back to FIFO based on a required switch, I mean, that's never, it hasn't been required of them, then those taxes are also not payable. So the value compounds tax-free as well. So I just treated, $300 million on top of the existing book value. That gets you like to close to $900 million. That's not the whole story of the asset value here, because they have an incredible amount of real estate, not to mention all the equipment, but they have roughly 10 million square feet of real estate. And I think almost all of that, if not all of that, is owned outright by the company. And a lot of this is very old real estate. It's been depreciated. It hasn't been marked up for the effects of inflation and the real estate market booming for warehouses. So, that real estate could be worth hundreds of millions of dollars more than what is carried out on the balance sheet. And they have an incredible amount of equipment that's possibly worth a lot more, and certainly on a replacement cost basis relative to where they calculate it. So I think on a replacement value basis, certainly the company is, replacement cost is well over $1 billion for the equity. I don't know, is it $2 billion? Maybe that's the high end. I'm not really sure. But the current market cap is $400 million. So the replacement cost is much, much higher than the current price.
And now, a quick word from our sponsor. Are traditional expert calls in the investment world becoming obsolete? According to Stream, they are. And you can access primary research easily and efficiently through their platform. With Stream, you'll have the right insights at your fingertips to make the best investment decisions. They offer a vast library of over 26,000 expert transcripts powered by AI search technology. Plus, they provide competitive rates on expert call services, and you can even have an experienced buy-side analyst conduct the calls for you. But that's not all. Stream also provides the ability to engage with experts one-on-one and get your calls transcribed free of charge, all for 40% less than you would pay for 20 calls in a traditional expert network model. So if you're looking to optimize your research process and increase ROI on investment research spend, Stream has the solution for you. Head over to their website at streamrg.com to learn more. Thanks for listening, and we'll catch you next time. And just to get, right now, again, the stock is about $54 per share. If I'm just using the Q1 2024 numbers, they run on a different fiscal year. So Q1 24, if I remember correctly, is end of June. I think that's correct. But Q1 24 book value is about $75 per share. Eris mentioned that's about just short of $600 million. So, I think a lot of people might look and say, again, canned vegetables, not the best business in the world. 2/3 of book, maybe about right. But then you would rightly point out, and I think I rightfully pointed out when I first got involved, hey, the LIFO reserve is about $40 per share. So if you want to do that math, it's actually add the LIFO reserve back, you're at $115 per share ish of book value. Now we're talking about trading for, 50 versus 115, well under half a book. Is this worth well under half a book? Probably not. And then, as you said, those adjustments I just made for LIFO don't add, I had done basically no work on the real estate. They don't add back anything for having undervalued real estate that I think is on their books from the 1990s costs. Am I remembering that correctly?
It's much earlier than that. So, I mean, this company's been around since roughly 1950. And the other side of the asset stuff is this is actually, once you make the adjustment for LIFO, it's actually a net, right? This is like a Ben Graham style thing, which is kind of funny because it's a decent business, I think. And I'm happy to get into the latter part because let's go. Most of my research has started focusing on is the quality of the business.
Yeah, so the third hook here is, right, I think there was the quick event play, and then I think there's the people who are going to play this as, hey, they came on and they showed me how to do the LIFO adjustments. Let's play this as a net. And both of those are completely fine, right? But where I think you've done the most work is on, hey, this is a better business than canned vegetables would have you think. So I know quite a bit of what you've done just because you've been so generous on Twitter, but I'll just flip it over to you. Why is this not the ultra commodity, terrible people business I think people would associate with canned vegetables?
So, the most money that you're going to ever make in the stock market is going to be figuring out a business fundamentally, not just what the numbers say and down, right? So
it's a great point because everything we just did, maybe not the LIFO reserve. I mean, LIFO reserve a computer could do, but there's a little bit. It's all, 30 minutes into income. Literally, that's what I did. 30 minutes of the financial statements, S&P kick, boom, I could calculate a book value. Book value was understated, boom, 30 minutes. The qualitative stuff that you're about to talk to is the stuff that, this quantitative stuff 50 years ago before computers was where the real edge was, but this qualitative stuff. Anyway, please go ahead.
You have to do the qualitative stuff if you want to make like the real money in anything, I think, because it's really easy to buy. It was really easy to buy the stock in the 30s and say it's got to be worth 50 or 60, right?
I don't know if it was easy, but I did it.
Right? All right. Well, anyway, so the story from my research, the story of the vegetable industry, tune out if you're not interested, is very long, and then it gets kind of like faster and faster in more recent years. So canned vegetables, canning was invented like 200 plus years ago. I think people attribute it to like Napoleon, who wanted to find a way to store food for his army, and so they invented canning. But canned vegetables have been around a really long time. And in the late 1800s and early 1900s, there were thousands of vegetable canneries around the United States. They were popping up everywhere, every little town. Basically, farmers were being told, hey, you want to make some extra money, find a way to can your vegetables, and you can then sell them for more, and they'll stay fresh longer. And so farmer associations were, making little canneries, and there were so many of these things popping up. And it was an awful, awful business, god awful, right? Everyone was just running a tiny little operation, and there was thousands of competitors, and nobody was making any money. These things were popping up and going bankrupt within like years, like not decades, right? And that just continued for a long time. Canning was an awful business. Del Monte ended up being one of the big consolidators in this industry. I think originally they were called California Packing Corporation, but they were around a really long time, and they bought up lots and lots of canneries, and they had their brand, the Del Monte brand, and they were making money because they have branded vegetables. They were originally kind of riding the wave of people like actually shopping for themselves in a grocery store, because way back in the day, you didn't actually go down an aisle and pick out your food. You told the grocer at the dry goods store, hey, give me some of this, give me some of that, and they'll go and grab it for you, right? So now, like, the customers are picking their brands, and Del Monte made money by riding that trend. And Del Monte was like the big dog and still is a really big player. And it went through a lot of different changes of ownership. But meanwhile, there were these other little canneries, and they were just going bankrupt left and right, and they were getting acquired. There was consolidation. So one of the big consolidators in this industry ended up being Chiquita, like a Chiquita banana. And Chiquita was buying up like the remaining players in like the 90s, right? So, but it's still fairly fragmented, and Chiquita was in no financial shape to really be doing this, but they were doing it anyway. And in the 90s, they were doing the consolidation. In the early 2000s, Chiquita went bankrupt, and they got out of the canned vegetable business. At the same time, there were a couple other companies that were kind of rising. They were on the consolidation trend, and the other big one here was Seneca. So Seneca started out. They were packing like frozen juice concentrate, like no one buys like frozen grape juice anymore or whatever, but like this was a product. And they moved into vegetables. I think they realized the juice business wasn't really, where to be long term. And so they did a really interesting deal. They bought the plants from Green Giant, which was a subsidiary of Pillsbury at the time. In like the 80s, they did this big deal, and they became the outsourced manufacturer for Green Giant. And Green Giant's the #2 brand after Del Monte. They did another deal, I think it was also in the 80s, I might be mistaken, to buy the plants and the brand from Libby's, which is the #3. So now they own the brand for Libby's, which is the #3 brand in the canned vegetable space, and they also got some more capacity from that. So Seneca's growing, but still they're not really making money in the 90s. And when Chiquita decides to sell off its vegetable canning business, that's when Seneca finally became like a big dog. And Chiquita sold most of that business to Seneca, and they sold a little bit of the capacity to the other larger player called Lakeside, which is a private company. I don't know why it was structured like that, but I suspect it might have been like some FTC mandated thing. Like you can't just concentrate the business that much in one go. So maybe there's some anti-competitive thing to not sell it all to Seneca. But for whatever reason, that's how they did it in like 2003. And once that happened, the remaining players in the industry, the big ones, were Seneca and Del Monte and Lakeside. Lakeside doesn't really have brands, but they're a private label canner. And that's when the business started to be decent. So you can let me take a break there if you want to ask some questions, because there's more to the story.
There is more. I know what's coming, but just to sum up, like, look, historically, yes, canned vegetables. Maybe there's a little bit brand. You mentioned Green Giant and Del Monte, like a little bit of brand value where you're walking down the aisle. In the similar way, if you're walking down an ibuprofen aisle and you see Tylenol versus store brand, you might pay up 20 cents for ibuprofen because it's something that goes in your body, you associate with it. I for myself know if I buy like the brand vegetables versus the generic vegetables, I kind of feel better and I feel like they're fresher, even though they're probably the same. So, but there might be a little bit of that. But until the early 2000s, this is the history. Airline industries now is a great example, right? 20 years ago, this is the most brutal industry out there. Today, it still might be the most brutal out there, but it's consolidated so much, it's down to an oligopoly. And once you get down to like 3 major players, you kind of like, you can start eking out some real economic profits once you get to the oligopoly level, benefits to scale. If you're doing 200 million, if your customers are Kroger and Walmart, you're investing 100 million into plants. Like there is scale benefit there, right? It's no longer you and I have a little farm and we can start canning vegetables and sell to these people.
Yeah, you want to make an oligopoly because there's actually different behaviors that are economically viable in an oligopoly. Meaning, you don't have to be quite as aggressive on price, and you want to be the biggest player if you're in an oligopoly because you get the greatest benefits of scale, right? So, Seneca, they've got like 20 plants. They actually have their own canning facilities, actually manufacture the cans that they actually use themselves. They're vertically integrated. They do their own seeds. It's a very vertically integrated operation. So there are benefits to scale in this business. And yes, you're right. So in an oligopoly, it's good. And on top of that, Seneca's, I can get into a little bit more of the story, but, Seneca's much larger than Lakeside. And is also larger than Del Monte in the vegetable business. And they've expanded that relative size advantage over time. So you want to be an oligopoly and you want to be the biggest player in an oligopoly.
Look, I think you did a great job with the story. I think you brought the story up to the early 2000s. I know there's a little bit more consolidation to come, so why don't we just keep diving into it?
Right. Okay. So what happened after that is Seneca had a good stretch, decent. They were doing pretty decent from roughly 2003 to 2013. And that's when shit kind of hit the fan. Del Monte was a publicly traded company in the US. Way before that, this thing was like a hot potato. You know, this thing was owned by RJR. This was like one of those, you know, it was in like all the big levered buyouts, food buyouts back in the day. This was like part of the, you know, stuff that was being shuffled around a lot. And it got taken back to the public market. And in, I think it was 2011, private equity bought it out again. They bought out Del Monte. And this thing owned a lot of pet food brands. It was really more of a pet food brand business. They have like a lot of the big names. So the private equity guys took the pet food business. They sold it to Smuckers for like $5 billion. And then the vegetable business, they had to find something to do with it. And they ended up selling it to this weird little company in Singapore that had the Del Monte business based in the Philippines, which had been around for 100 years as well, but had been carved out in like the 80s and 90s when they were, you know, shuffling things around in these big buyouts. They like somehow at some point they carved out the Philippines business and relisted it in Singapore. And then it bought the American Del Monte business in 2014 and reconsolidated most of the Del Monte brand for canned vegetables. And those guys just messed up the business, basically. I mean, they did an awful job. I don't know why they were so bad at managing it, but they were like really, really aggressive trying to.
A question I ask myself all the time. I don't know why these guys are so bad at managing this company, but they are
just so bad. Like, it's not rocket science, right? They have a brand. They have the strongest brand in the space, and yet they found a way to lose money on this basic kind of business, right? So they were doing a lot of private label. So, you know, Del Monte, in rough terms, I don't have the exact breakdowns today. I think today more than half of canned vegetable sales are private label. Del Monte has a total share of like 20 or 25% in the market. So I think it's like private label is like a little more than half. Del Monte is like 20 or 25%. Green Giant's maybe like 10%. Libby's, which Seneca owns, is less than that. And so, like, you know, Del Monte was trying to, you know, keep selling a lot of vegetables, partly by, you know, moving into private label more and more. And that really hurt Seneca. And they said that in their, you know, their annual reports where they have investor letters.
I should mention, there's not tons out here. This company doesn't do earnings calls or anything, at least to my knowledge.
That's right.
They don't. But their annual report and some of their proxy statements, if I remember correctly, they do actually like do a pretty detailed annual report that's like, hey, we'll talk about it when we get there. We're ramping up CapEx because we're buying back shares because we see value in our stock. We're not buying back shares because we've got this huge inflationary issue and we want to make sure we pay down. Like, they actually do disclose a decent bit. I mean, we're not talking like Warren Buffett, Berkshire style letters, but they disclose a decent bit about the business in the annual reports. And I tracked them back to for 5 years and felt pretty comfortable. I'm sure you went further than that, but just to add that.
Yeah. So this business had a really, really unreasonably aggressive competitor starting in like 2014, 2015. And the nice thing about, you know, unreasonable aggressive competitors is that they tend to not be able to do it for very long because they'll go bankrupt. And the Del Monte guys at some point realized that. And by 2018, they were kind of slamming on the brakes because they realized, okay, we're losing money somehow, even though we have this really strong brand and we're one of the biggest players in this industry. We shouldn't be losing money. And so they fired the old guys and brought in a new guy to run the US business. And he looked at it and said, we shouldn't be losing money. And so we decided to get out of the private label vegetable space. So they did that. 2019 was their last major harvest before they sold a lot of their capacity. They shut down a number of their plants and they sold a couple of them to Seneca. And once that happened, so recall previously, you know, I said that there was Seneca, there's Del Monte, and there's Lakeside. And Seneca and Lakeside are really focused on private label. Once Del Monte exited the business, now there's only two players that are of any real consequence that are focused on private label. There was another company that I didn't mention because it's just more confusing to mention it, but there was a company called Allen's that was a family-owned company. And they were one of the larger players in canning as well. They have some of their own brands. And that business went bankrupt 2013, 2014. And Del Monte made a mistake by outbidding Seneca for the assets from the Allen's bankruptcy, which just hastened the demise of Del Monte. So there was an additional quirk as well. There was more competition that was leaving. And once you got to this point, Del Monte needed to slam on the brakes. They're getting on a private label. That's when the business became not just an oligopoly, but like practically a duopoly. So Seneca is like, probably 3 to 4 times the size in canned vegetables relative to Lakeside. And Lakeside's the biggest competitor. So now it's not just that you have, a few players. It's like Seneca's the guy who's going to can your vegetables if you're a grocery store, right? And you can try and go out there and find somebody else, and there are probably a couple other small players out there, but they're the big dog, and so they're going to have the biggest economies of scale, and they're going to have the most pricing power.
That was a fantastic background. Let me ask you one question, just for listeners. Like this is not a duopoly in the sense that Facebook or Google and whoever can have a duopoly. Google and Apple have a duopoly in iPhones, right? Like there are competitors, there are substitutable products here, right? It's private label canned vegetables that we're talking about. You could go with Del Monte, so you could buy a brand, or you could just buy fresh vegetables. And yes, that's not always actionable, but there are substitutes. So just want to like, how much of canned vegetable business is private label versus branded?
Well, I think it's probably a little over 50% private label.
Yep. Perfect. Okay, great. So we're kind of up to date, right? We're up until 2020, 2021. Del Monte's pulled back from the private label canned vegetables. I think 2021 to 2023, people can kind of guess what happens with inflation, everything. I don't know if you want to quickly speak to any of that. Yeah, obviously, we talked about it a little bit in the LIFO reserve, but
that's what makes this business hard to understand today. That's what's made the last couple of years seem not quite as good as they are. Okay, so we've gotten to 2019, 2020. Seneca's probably the dominant player at this point. COVID hits. People stock up on canned food, fill up their pantries. It's a great year for canned vegetables. Seneca has their best year ever. And after that, inflation really hits. Steel prices are shooting up. Food prices, prices they have to pay their farmers to grow vegetables are skyrocketing because of the war in Ukraine, because there's a need for farmland, because Ukraine's farmland was kind of taken out of the global supply. So there's massive inflation. And as a result, the company is obviously going to have to raise their prices, but there's going to be a time lag. And one of the big questions that's still not fully answered, but I think I've had a better handle on it than maybe some other people have had, is how quickly does this company raise prices? In the past, in a few of their past annual reports, their shareholder letters, they've said that they have some degree of annual contracts. And on top of that, Del Monte has made some comments about having longer term contracts and having to take some time before they can raise prices. When you're not able to raise prices the day of an inflation shock, look, you find out steel prices just went up, 20% in a month or two. Well, what are you going to do? Well, if you're locked into some longer term contract, 6 months or a year, you can't just make that up tomorrow. So you're going to have to wait, and then you're going to raise prices. What that means is that your FIFO numbers are probably going to benefit a little bit from inflation. I'm not really sure if that's even true, but they're not benefiting enormously from inflation. I think some people had this idea oh, you've got this big warehouse full of canned vegetables and steel prices just went up yesterday. So today you're going to sell those canned vegetables for much more than you would have sold them yesterday, which means that you're capturing this massive benefit on a FIFO basis from inflation. And there have been some people who have said, I don't think FIFO is a real number for this company because you're just riding the inflation trend, right? You're just selling your vegetables for more because they're worth more today than they were yesterday. I don't think it's that simple.
Let me provide one support and one push. The reason people like to use FIFO is generally how you manage a business, right? Because you make a product and that's the product you're going to sell. Think about if you're stocking a grocery store, right? You stock from the back. So the person takes the front thing and then you put the freshest product at the back. hoping that the people take the thing at the front because that's the oldest product, that's the nearest section. So you're trying to sell the first things in and then the last things at the back. That's why FIFO makes the most sense. Like to your point, could you benefit from a FIFO wave? Yes, it just depends how much inventory you're carrying, right? Like if Seneca was sitting here with 15 years worth of inventory in their warehouse, yeah, inflation would be, they would just be riding the inflation trend. But from memory, I think they turn over their inventory like 2 or 3 times. I can't remember for sure.
It's like 2 or so.
Yeah. So it is true. They are going to benefit from a little bit of inflation in a FIFO accounting, but that's a one-time benefit. And as you said, it's not going to be huge. I mean, look,
the point is, the first point about how much inventory you have is one of the important points. The second point is how quickly prices change.
Yep.
And that's something that people have not really addressed. And I think the company has said that their prices do not change immediately when input costs change. So it's those two things, both the inventory quantity and the time lag to get better prices, those two things have to be taken together to come up with some intelligent estimate of how much this company benefits on a FIFO basis from inflation. So, yeah.
Let me move to the two most interesting things to me here at this point. Okay. Number one, on the downside. So this is the thing I had the most trouble with the company when I was looking at them, right? Like, people can go look. They've historically actually done a really nice job. They tried to do, from memory, they tried to do a tender offer for a lot of shares. That tender offer, I think, failed because they couldn't get enough shares tendered. But then they just went out and they historically have bought back a lot of shares. You know, I'm looking in 2000. Where's my numbers? In fiscal 2022, they buy back 8.5% of the company at $50 per share. And the CEO, you know, if I remember from an annual letter, they say, hey, we're going to keep doing this as long as it makes sense for our shareholders, and we think it does. So that's a huge point in their favor. The thing I had, and we can talk about that if you want, but the thing I had the most trouble with was this is a very controlled company, you know, right? That SENA, we talked about SENEA is the publicly traded shares. There's also SENEB, which is the shares management controls, which gets 20 times the vote as the Class A shares. Very controlled. And then the thing I thought was especially weird, there's all these weird preferred shares outstanding that are convertible, get special designation privileges, has special dividend rights that the insiders control. So like kind of the reason and again, I'm putting my own historical trading bias here maybe, but I bought it on the index kick. It went up a little bit. And then I was like, you know, the last earnings report was great, which we'll talk about. It went up on that. But I kind of looked at it and I was like, oh, you know, I was here for an index kick. I never got comfortable with the control and the prefs and everything. And that to me was the biggest negative why I was like, oh yeah, I'm probably selling at half-ish of book value, but I'm really nervous about the control here. So I threw a lot there. I'll turn it over to you.
Probably something that people worry about until they don't. Lots of big tech companies are controlled either via, you know, preferred, you know, variable share classes or just from an owner who owns most of the company, right?
You say it's something you worry about till you don't, and you're 100% right. But if you think of 2022, a lot of, especially, you know, I think of Facebook going down is, oh my God, Mark Zuckerberg is going to light $30 billion a year on fire on this crazy metaverse thing, and no one can stop him. And like the control, Facebook, Google, all those are high examples, but I can point you to a lot of smaller companies that are controlled that trade for huge discounts because everybody's like, oh yeah, they're going to pay themselves all the money and light everything on fire.
Because they're jerks, right? Yeah. They're running the company. Well, the good news is that from Seneca's history, they're not jerks. They don't pay themselves very much. The board is not just the management team, and the board also owns quite a bit of economic value of stock. So the board is actually, I think, you know, decently aligned with the other shareholders. And their history has been that they've treated shareholders very fairly, I think. Look, it wasn't a good business to be in for a very long time, but they've made money for their shareholders. And when they've had the cash, they've done buybacks. So I think the control is part of the reason why the stock is cheap. I think the reason why that is not so much because the control means that there are bad people who are going to take advantage of you. It just means that there's been no potential for any aggressive fund to come in and try to juice things, right? Like if this thing didn't have variable share classes, there would have been a couple activists who would have come in and tried to, get these guys to start having investor days, have investor presentations, have conference calls, for God's sakes, right? There are some things that the company could do to quickly get the stock up just by communicating more that it's chosen not to do. And because they don't have the threat of activism, they've been able to continue like this, right? And I think that's the biggest, quote unquote problem related to the dual share classes.
What's funny? You mentioned an activist coming in, and there's a few companies I'm in where I'm like, God, I wish an activist would come in here. If an activist came in, their first thing would be like, let's buy back a lot of shares at a fraction of book value. Let's tender for the stock. It's like, hey, that's exactly what the company is doing or has tried to do.
Yeah, but today, so one of the knocks is that because there's been so much inflation, and because the company also had to restock after they ran out of canned corn during COVID. They were selling so much more than they expected. And they really want to beef up their inventories. And then on top of that, there was a potential threat from potential steel tariffs that were going to hit them. I mean, it wasn't going to happen necessarily, but there was some risk of that. So they loaded up on raw steel. The tariffs ended up being kind of like a nothing burger. But they really juiced up their inventories after, COVID. And so they needed to take on some more debt to do that. And these guys appear to be so conservative that they've just paused the buybacks. Now they had to take on this debt for working capital, which a hedge fund activist would say, don't do that. We're going to take on more debt and buy back more stock, right? And it's funny because sometimes you hear people say like, oh, I don't want to own them because they have too much debt. And then like the same day, you'll hear somebody else say, I don't want to buy it because they're not aggressive enough by taking on more debt to buy back stock. Like there are people who will just be in one side or the other side saying that, the company is doing it wrong, but they're just going to have their own opinion. Everyone's going to have their own opinion, right?
No, look, I'm a little jealous because you front ran my next question here, but the debt has ballooned up, right? Like I'm doing this from memory, but I believe they used to peak at like the low 100 millions. This is a seasonal business, right? During the summer, harvesting and storing, and then you kind of sell it all throughout the year. So it's a seasonal business. So the summer months, you build up inventory, you build up working capital. And from memory, I believe they used to, in the summer months, peak at like 100 to 150 million in kind of debt to fund that working capital. And this year, right now, they're at about 450 million. And again, some of that's inflation and all that. But I think you've addressed most of it. I do think there is some people have the question of, hey, is this business now, like you've pointed to the ROE, the company you earned. Do people might say, oh, it's a more capital intensive business? So like, do returns come down, or is it a riskier business because you have to invest more into this kind of inflated working capital? I'm not sure where I'm driving, but I know that debt number, when you see it spiking up, I think a lot of people look at that and get a little bit of pause.
It's another reason why people have passed without doing more research is what it is. Look, they've got over $200 million of LIFO EBITDA. Okay. On a debt to EBITDA basis, it's less than 2 turns. You can easily lever up businesses more than that. When people say, oh, it's been going up, well, yes, in this period of extraordinary events happening with inflation, inventories have gone up. In addition to the other things that I described. People are generally very good at extrapolating, and they're usually not very good at understanding. So we're in a situation now where if you extrapolate recent history, you will be worried. But if you understand the history, you probably won't be worried. And that's where I kind of come out on it.
That's perfect. Let me just ask a completely separate question. The past couple annual reports, the CEOs come out and said they clearly measure CapEx against depreciation, and we've mentioned DNA, EBITDA several times. And I'm just looking at my quote from the 2023 annual report. In fiscal 2023, we invested 208% of depreciation into CapEx, as well as, let's call it 15% of our CapEx financed through leases, which adds on top. And I believe in 2022, from memory, it was like 145 or 150%. So they're investing in excess of depreciation, which is one of two things. A, inflation has run it up, so depreciation is actually understated, right? This is all maintenance CapEx. Or B, they're investing in growth. I think the right answer is C, some combination of the two. But what's kind of the growth that they're investing in for this CapEx?
They bought the Del Monte capacity. So they bought a couple of facilities, and they've also upgraded some of those facilities. So, like, for example, there's one facility they bought in Wisconsin, which is one of the core states where they do business. They bought this facility from Del Monte because I guess they thought it was one of their better plants that they wanted to keep rather than shutting it down. And they put a big addition on it. I think they built a big warehouse addition to it, and that's part of the strategy to have the most efficient operations. You want to be able to co-locate things as much as possible to reduce shipping costs. And they're just trying to have the most efficient basic capacity out there, right? So yeah, I mean, there's incremental stuff. I think they expanded some plant where they're processing pumpkin for canned pumpkins used for pumpkin pie. But like, yeah, there's not a lot of innovation that happens in the canned vegetable industry, right? So yeah, like you'll have some upgrades, and when they did a big thing, like they bought the Del Monte plants, they'll put some more money into them. But I'm not really worried about the CapEx so much.
No, I was just more asking the question of what they're doing, because I think the two things I was trying to drive at is A, CapEx was, use 2023, 70 million of CapEx versus 210 million of FIFO EBITDA. Like there's still plenty of kind of unlevered free cash flow on the back end of that. And B, as you said, some of this investment is in upgrades. So you're seeing the CapEx come out the business, but again, this isn't like 100% ROE business, but there should be earnings in the near future from that growth CapEx is what I was kind of driving at. That's not in the recent past. Where else was I going to go? Look, I think we covered most of what I wanted to talk about. I guess, how are you viewing your investment? How do you think this plays out? Is it just waiting for, hey, I'm going to wait for it to get to kind of 1x book value and then I'm going to sell? Or do you think the family eventually takes it private? Like, how are you kind of viewing the end game for this investment?
Well, at some point they're probably going to sell, right? I mean, they can't buy too many more
between companies. Now and the inevitable heat death of
between
the universe, everything gets sold. Yeah.
But look, the question is what it's worth, right? And the good news is there are lots of comps, not just publicly traded comps, but deal comps, right? And I've done a lot of work to find every comp I can. And the upshot of the story is that private label food is generally considered a pretty good place to be, because we didn't get into this so much before, but like you go to a Walmart or whatever, and you're going to have Del Monte on the aisle, and you're going to have some store brand, and the store brand is probably going to be from Seneca, and that Del Monte can of corn is going to cost like twice as much as the private label brand. So you're going to go to a store, you're going to have Del Monte sitting there at $1.40 or $1.50 a can, and you're going to have, whatever, I don't know, Target brand or Kroger brand, and it's going to be like 70 cents or something, right? And over time, customers in general, consumers have wanted to, get the same quality cheaper, and that's really what this is, right? And so there's been more and more private label over time, and everyone wants to invest in this trend. Private label is a good trend.
As you said, it benefits everyone, because this is something, unless you are, again, there is something to the brand and stuff, and we talked about the Tylenol and everything, but the stores have done a great job. Costco is the original with Kirkland's, but the stores have done a great job of turning their brands into like, it's not the old Sam's Club terrible Coke that you used to get. A lot of these stores have invested to make their brands better. And if you think people want to save money and the store brands continue to get better, like I think about Target, and I've been getting hit with football, the illegal streaming sites I use, they're basically sponsored by the Target home brands. Like if you think the stores continue to invest in the private label because it saves people money and the stores make more margin, then the canned goods should be the private label canned goods should be taking more share over time. So it's like a long-term mini tailwind, I guess.
Well, the question is, where do you want to be in this business, right? Like a brand is probably going to continue to lose value over time, given what's been happening, right? Sorry, me get some unclear. And what that means is that more and more of the value is going to be going towards some other part of the value chain. And I think what's happening is more of the value is going towards the largest, most competitively advantaged manufacturer, right? So what used to be a good business in this space, Del Monte, is becoming less and less of a good business because Del Monte is now still the largest brand, but not the largest manufacturer. In the future, when the manufacturers are the valuable part of the value chain, people aren't going to say things like, "Oh, this is a okay looking business but doesn't have a brand," because, in my opinion, brands aren't even the things that are great anymore. A lot of people have realized this. Post, right? Post is apparently very well run. People seem to really like the guy. And they really like the private label food space. They've done a lot of deals. Treehouse Foods is sort of a lesser well-known and not as well-performing private label focused business. There have been other companies that have, tried to roll up different areas in private label. And a lot of these deals have taken place in the past, 5-10 years. And it's something like, 10 times EBITDA. There was even another big deal I think I just saw, last year, like the biggest manufacturer of bottling, like bottling company, right? They just bottle like juices and sodas, Refresco. And I think KKR just bought them for 11 times EBITDA or something.
And now, a quick word from our sponsor. Are traditional expert calls in the investment world becoming obsolete? According to Stream, they are, and you can access primary research easily and efficiently through their platform. With Stream, you'll have the right insights at your fingertips to make the best investment decisions. They offer a vast library of over 26,000 expert transcripts powered by AI search technology. Plus, they provide competitive rates on expert call services, and you can even have an experienced buy-side analyst conduct the calls for you. But that's not all. Stream also provides the ability to engage with experts one-on-one and get your calls transcribed free of charge, all for 40% less than you would pay for 20 calls in a traditional expert network model. So if you're looking to optimize your research process and increase ROI on investment research spend, Stream has the solution for you. Head over to their website at streamrg.com to learn more. Thanks for listening, and we'll catch you next time. Yeah, look, everybody loves the bottling business. I certainly hear what you're saying. And I think the important thing is this is 4 times FIFO EBITDA, 6 times LIFO EBITDA, right? So whether it's 8 or 10, there's a lot of upsides to hitting that multiples. And whether that's FIFO or LIFO, there's still a lot of upsides to hitting that multiple. I hear you. I definitely hear you on there's a tailwind of the brand is getting less good. The mega brands as media fractures, it's harder to support a Del Monte brand. Right? You walk into the store, you buy Del Monte because you've got the fresh association with it. It's harder when they have to micro target everyone and they have to compete with TikTok ads for video games for attention. I think a lot of people, especially you're my age, would just walk in and be like, "Oh, I could buy a can of green beans for 70 cents here or $1.40 here. Let's just get the 70 cents." So I definitely hear you in terms of all those tailwinds. I'm somewhat skeptical that most of that value doesn't accrue to the consumer, and then of the sliver remaining, I think it goes to partly the store and then partly the manufacturer. But even if they're capturing a sliver of value, that is a sliver they weren't capturing, and they're getting larger. So yeah,
we can talk about the reason I came on this podcast in the first place is partly because I was listening to a couple of other pitches on the podcast about Lamb Weston, and Lamb Weston is a vegetable processor that processes potatoes and freezes them and cuts them into different shapes for French fries. And Lamb Weston is in an oligopoly with, I think, 3 major players. And it's a very high ROE business. And it's a stock that people love.
As you said, it trades at 18 times EBITDA. This is an oligopoly, and Senea is an oligopoly in vegetables, and it trades at 3 times EBITDA.
Well, so vegetables, unfortunately, canned vegetables are not growing at all. In fact, they're probably shrinking by maybe 1%, 2% a year. I don't know the exact number. Whereas French fries are still growing. So in a rational oligopoly, you'd prefer to be in the fry business than the camp core business, right? But besides that, it's funny because your pushback against, this being a decent business is fair, but it's pushback that I don't hear so much about something like Lamb Weston simply because the numbers have been there for long enough.
To be clear, I wasn't pushing back on this being a decent business. I was pushing back on this being, I guess, an above decent business, if that makes sense. Like, I think this is valued like a net, and I think it's a decent business.
Lamb Weston has negative tangible book value. Negative, right? We're not talking about this thing as trading at or above tangible book value. Lamb Weston, on a book value basis, is worthless, right? Del Monte actually, although it's not publicly traded, I should specify the U.S. Del Monte business, Del Monte Foods, which may in fact re-IPO in the U.S. near term because the Singapore parent needs to raise some money. But that business also publishes financial reports specific for the U.S. business, and you can find them. Del Monte, the U.S. Del Monte, also has basically zero tangible book value. My frustration has been that, people have chosen to focus on, like, is this worth 1 times book value? Could it ever get to 1 times book value? Where I see lots of other companies that look similar, where people aren't even thinking about book value, and in fact, tangible book value is, 0 or negative. And they're looking at the earnings. And the reason they're doing that is partly because, well, they can't look at tangible book value, because if they did, they'd look like an idiot, because you can't say any of these businesses are worthless, even though there's no tangible book value.
So,
right?
On the one hand, I do hear you, right? I certainly hear what you're saying. But on the other hand, like, so just to use LW, so I just pulled out their earnings statement. Like, they're going to do $1.5 billion of EBITDA on it, and I'm doing this very quickly, but about $4 billion of tangible invested capital, maybe a little bit less. If it's tough to do the working capital adjustments in my head real quick, but like, that is fine. Throw in taxes, throw in, like, DNA is real. That's a 20% return on invested capital business. Now, it is lower growth. Like Sena, again, I think it's a decent business, but I just think the structure, like, I don't think you and I are talking about it doing 20% return on invested capital, right? We're talking about it doing now.
The French fry business is better, at least at this point in time. It is. Look, like the first quarter, the June quarter of this year for Seneca was
actually my last question. Yeah.
I've heard a lot of pushback on the stock from people who also don't address the fact that they just reported an outstanding quarter, in a quarter where things finally should be getting better because there's no inflation anymore in this business at the moment. And it's the seasonally weakest quarter of the year for them. Typically, the second quarter, the September quarter, is much stronger. Part of that's because they sell Green Giant, I think, most of their product every year in like one big lump once they do the harvest and pack. And there's also seasonality in this business because people buy more of their products around the holidays. So if they just reported a seasonally weak quarter and it's close to $3 of earnings, and you can look at the seasonality is quite significant. I've been saying publicly on Twitter, I think the company is going to earn $15 a share. I don't even think it's aggressive. I don't think $15 is like an aggressive number. I've heard a couple of people say, there's no way they're going to make $15. How can they make $15? The stock's at $50 or something like that. It's like, well, what do you think they're going to do? Like, how much money do you think they're going to make? I mean, there's no sell side expectation. So it's like,
it's funny you're getting pushback on. It's funny you're getting pushback on 50 because I'm just looking at my trailing 12 months number is 14, right? And as you said, the Q1 earnings they reported in their seasonally weakest quarter, now that like inflation stabilized and everything, was kind of a blowout. And I just kind of look at the two and I'm like, I mean, again, you can provide pushback on the ideas. There's the control, there's other stuff, there's the debt. But it's hard to look at it and say, hey, they're not going to do 15 because if they just do what they've done over the past 12 months, they basically hit 15, right?
Yeah. And you're buying, like, you might not be excited about the canned vegetable business because there's no growth. But is Campbell's growing? Is any packaged food company growing?
Is Coke growing? I mean, it's a great question.
Is Coca-Cola the product growing? I mean, like lots, I've looked at lots of comps, and like lots of these packaged food companies, they're not growing. In fact, a lot of them are shrinking quite quickly relative to Seneca. And people still like the stocks. They give the stock 15 times, 20 times earnings. But like, here's something that probably is at 3 to 4 times earnings right now. And it's not even like really that hard to figure it out. And, you know, people are like trying to poke holes in it, but like, why is it hard to value this company at over 10 times earnings? I just don't see like the difficulty of doing it. And,
you know, and that's the thing. If it's
not,
like,
it's not hard.
If it's a stable business with ROEs in the 10 to 15%, right? Like a cheat is 10 to 15%, probably deserves to trade for 1 to 1.5 times book. Maybe people could start arguing too, but like we've laid out all the math, we've laid out all the reasons, and you can kind of do your own. Anyway, here's any last words that you want to throw in here? I realize we're kind of approaching over an hour at this point.
I'd love people to, you know, find more information, because like management is not generally available to speak to shareholders. I reached out to them. I have friends who also reached out to them. I haven't heard back. I know somebody who spoke with them at their annual meeting, but besides that, they don't really have an interest in talking to their shareholders. I think the challenge here is that I haven't heard anybody else who has done research. Like I've heard from people who have looked at the financials, but I haven't met anybody who's done research. And so I don't think I'm the best qualified to do the research, because I don't have a large research budget. And if people want to do some research and share it, I would love to hear from them. I think that's how I would leave it.
Perfect. I like that. Well, you know, speaking of hear from them, I will include a link to Harris's Twitter in the show notes. And Harris has done a lot of posting, some decent. I mean, one of the write-ups that like got a ton of people interested in Senate to begin with was your write-up. Everybody can find that on Twitter. People can reach out to you if they want to swap thoughts on it, see more of that research and stuff. But look, Harris, this has been great. I think this is a fantastic idea. I think, as you said, a lot of people, me included, did like, oh, here's the financial statements, but you did really excellent fundamental research on this, history of the industry, and just appreciate you coming on and, you know, sharing it with the listeners, and looking forward to having you on for the second time.
Yes, I have to do an update at some point.
Cool. All right. Hey, it was great. Have a good one, man. A quick disclaimer: nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.